Right, let's get right to it. S&P 500 futures are basically flat to green, clinging right to that 69.25 level. We are seeing a pretty distinct defense of record highs this morning, but I'm going to have to stop you before you get too excited about the green ink on the screen. The VIX, the volatility index, is sticky. It's hanging right around 17. So the bulls, they aren't exactly charging. They're waiting.
Exactly. The mood isn't euphoria, it's caution. The market's just holding its breath. And to understand why, you have to look at what happened, while the U.S. was sleeping. The overnight catalyst was, without a doubt, geopolitical de-escalation. The White House walked back those Arctic tariff threats and all that aggressive rhetoric regarding seizing Greenland.
Which is huge. And we should probably explain why the market even cares about Greenland. I mean, to the average person, it sounds like a game of risk. But for the market, it was a massive red flag, wasn't it?
It's all about tail risk. In finance, a tail risk is that, that rare catastrophic event that falls way outside the normal curve, the black swan, and threatening to seize territory. That created this huge geopolitical tail risk involving NATO partners, shipping lanes, everything. So by walking that back overnight, the administration basically just took a massive risk premium right off the board. Investors don't have to hedge against a northern conflict today.
Okay, so that's a relief. But looking at the futures, we aren't seeing a massive rip higher. If that risk is gone, why aren't we popping the champagne?
Because the market has already moved on. It's pivoted instantly from geopolitics to the macro clock. We are staring down a serious data gauntlet this morning. At 8:30 a.m. Eastern, we get a doubleheader. Q4 GDP, the final estimate, is looking for 4.3% and jobless claims. Then, just 90 minutes later at 10 a.m., we get the big one, the Fed's preferred inflation metric, core PCE.
So let's unpack the stakes here.
Yep.
4.3% GDP is a really strong number. In a vacuum, strong growth is good, right? Companies make money, people spend. Why would we be worried about a strong economy?
In a vacuum, yes, growth is fantastic. But we are not in a vacuum. We are in a very tight Fed cycle. If we beat that 4.3% number and that inflation data, the PCE, stays sticky or comes in high, well, that creates a massive problem for the Federal Reserve.
Because it just ties their hands.
Precisely. The market is currently priced for a soft landing. That's the Goldilocks scenario, where growth slows down just enough to cool inflation, but not enough to crash the economy. But if that GDP print comes in hot, say 4.5% or even higher, and inflation doesn't budge, we're not talking about a soft landing. We're looking at a no landing scenario.
No landing, meaning the plane just doesn't come down, it just keeps flying at high speed, high altitude.
Right. And if the economy doesn't land or cool off, inflation stays hot, which means interest rates stay higher for longer. The floor on rate cuts just drops out. Those insurance cuts the market was hoping for later this year, they vanish. If the economy is running this hot, the Fed has zero justification to cut rates.
And lurking in the background of all this is that Supreme Court challenge to the Fed's independence we've been tracking. It kind of feels like a theoretical law school debate. Does it actually matter to a trader watching the screen today?
It matters immensely. It adds this whole other layer of structural anxiety. The market operates on the core assumption that the Fed is independent from politics, that they make decisions based on data, not polls. If the court rules against the Fed's independence, if the Fed that idea that the Fed will always save the market becomes political, well, that changes the risk calculation for every single asset on the planet.
Okay, we'll circle back to that nightmare scenario later. But first, let's look at who is actually moving money this morning. Despite the macro holdup, we've got some serious pre-market gappers.
We do. And the theme today is clearly execution over narrative.
Leading the pack is Intel, ticker INTC. It's up 11.7% pre-market.
Yeah.
This is a massive move for a legacy chip maker that, let's be honest, has been the butt of a lot of jokes lately.
It has, and this jump is justified. It's a massive earnings beat. But it's not just the numbers, it's the qualitative shift. For years, Intel has been a turnaround story. Investors were just betting on hope. This report, it signals a real pivot toward AI-integrated foundry services that is actually, generating revenue.
Okay, helpful listener out here. What do we mean by foundry services in this context?
Think of it this way. Historically, Intel only cooked its own food. They designed their chips, they built them for themselves. A foundry model is like opening up their massive industrial kitchen to other chefs. They're saying, look, we have these huge factories, we'll build chips for Amazon, for Microsoft, even for our competitors.
So the story's shifting from, can they fix their own chips, to, can they become the factory for the entire AI revolution?
Precisely. The market is betting the turnaround is finally real. Specifically, they're looking at the execution in the AI data center segment. That is where the margin expansion is going to live. If Intel can prove they are a viable alternative to TSMC for manufacturing AI chips, that 11% gap is just the start.
Speaking of AI finding a fresh gear, let's look at SoftBank, ticker SFTBY, gaining 11% as well. This feels connected to what we saw in the Asian markets overnight.
Oh, it's a direct correlation. The KOSPI in Korea had a record-breaking rally, and SoftBank is basically the proxy for that global exposure. The AI trade isn't dead, it's just rotating geographically.
Because for the last 2 years, the AI trade has been so US-centric. NVIDIA, Microsoft, Google.
Exactly. But investors are realizing that the U.S. doesn't have a monopoly on AI infrastructure. SoftBank is the vehicle they use to capture that Asian growth. It's a way to play the AI boom without, buying the same expensive U.S. names. It's about finding value in a very crowded trade.
Okay, moving away from tech for a second, we have a breakout in healthcare. Alignment Healthcare, ticker ALHC, hitting a fresh 52-week high in the pre-market. What's driving a healthcare stock to move like a tech stock?
This is a pure growth story. The data point just jumping off the page is their membership growth. It's running at 31% year over year.
Which, for context, is just vastly outperforming the legacy Medicare Advantage peers.
It's unheard of in this climate. I mean, this whole sector has been plagued by regulatory headwinds, reimbursement cuts. Most insurers are just struggling to maintain their margins. So finding a company that can grow membership at 30% plus is rare. It's attracting a lot of attention from growth-hungry funds who want diversification away from tech but still want that double-digit growth.
And finally, on the industrial watch, we've got GE Aerospace, ticker GE, reporting Q4 earnings. Everyone watches GE, but what specifically are the eyes on here?
Two things: commercial engine delivery numbers and 2026 free cash flow guidance. GE is the bellwether for the industrial supercycle. The question is purely supply chain. Can they build the engines fast enough to meet the demand?
So it's not a demand problem at all. Airlines want the engines.
Airlines are desperate for them. I mean, they have order books filled for a decade. It's a supply problem. If those delivery numbers are light, it signals broader supply chain issues for the whole aerospace sector. It tells us the industrial machine is still clogged up.
Okay, those are the movers. Now let's talk strategy. The bell is about to ring and we need to know where the lines are drawn. Let's start with the S&P 500, the ES futures.
Right. So yesterday we saw a bounce, but it stalled right at that psychological ceiling. Today is about confirming the floor.
So where's the wall? Where do the sellers step in?
Resistance is at 6,900. It's clean. We need a 4-hour close above 6,900 to attract any kind of FOMO, liquidity, fear of missing out. Until we break that, we're just chopping in a range.
And the line in the sand, the must-hold level for today.
68.20. 68.20. This aligns with the 2025 year-end close and the origin of yesterday's breakout.
And if we lose 68.20, let's say PCE comes in hot and we just flush.
We slide. Yeah. And fast. The downside target is 67.80. If 68.20 fails, you can expect a quick flush down to the 50-day moving average. There just isn't much structural support in between. It's an air pocket.
All right, let's look at the Nasdaq 100, the NQ. Tech is leading futures up about 0.59%, but you've noted the air is getting thin up here.
It is. The resistance to watch is 23,450. A break there targets the all-time high zone at 23,600, but the real risk is to the downside.
Where's the support level that tells us the trend is broken?
22,950. If we fall back into the 22,000s, it signals that yesterday's move was a fake out. Yeah. It means the buyers just didn't have conviction. Below that, you're looking at 22,700. That's the institutional bid zone. That's where the big desks have their buy orders sitting.
There's a concept you brought up in the notes, the trap risk. It feels like we're walking on eggshells here despite the green futures. Explain what you mean by a fragile breakout.
Look at the volume yesterday. The rally was 1.2%, which sounds great on the news, but the volume was low. It looks more like a short squeeze than it does institutional accumulation.
Okay, let's define that difference. Accumulation is big funds buying because they believe in the future value. What's a short squeeze?
A short squeeze is when traders who bet against the market, the shorters, they're forced to buy back their positions to stop the bleeding. They're not buying because they love the stock. They're buying because they're in pain. They are covering their tracks.
Meaning people were covering losing bets, not opening new winning ones.
Exactly. And that makes the price action brittle. It's like ice that looks thick but is actually hollow underneath. The smart money is sitting on its hands waiting for those 8:30 and 10 a.m. prints. If ES fails to hold that 68.20 level after GDP comes out, then everyone who panic bought yesterday is officially trapped.
And when traders are trapped, they panic sell.
Which just accelerates the downside. That's why we call it a trap risk.
Let's zoom out a bit. We've talked micro moves, but the macro overlay is what dictates the flow. We have the 10-year Treasury yield sitting at 4.24%.
Which is high. It has cooled a bit from that 4.31 spike we saw, thanks to that Greenland thaw. But 4.24% is still a significant headwind.
And the dollar index, the DXY, is in the mid-90s.
A mild tailwind for multinational earnings, sure. A weaker dollar helps companies like Microsoft or Apple who sell overseas. But it's not enough to offset the pressure from yields. I mean, when you can get 4.24% risk-free from the government, the hurdle for buying risky stocks is just higher.
This brings us to what you call the pain trade. Usually when people hear pain trade, they think of a market crash, losing money. But you're arguing the pain here isn't losing money, it's opportunity cost.
Exactly. This is the nuance that so many retail investors miss. The retail trap right now is buying the dip in high multiple tech and the magnificent 7 names. They see NVIDIA or Apple down a few percent, and they just think it's a sale.
Because that worked in 2024 and 2025.
Yeah.
You bought the dip, you made money, it was automatic.
Right. It was Pavlovian. But the environment has changed. In a high-yield environment, anything with the 10-year over 4.25%, the market broadens. The smart money isn't buying more tech, they're rotating. They're moving into industrials, mid-caps, that's small and mid-caps and financials.
With boring stuff.
The boring stuff that is making new highs.
I like the analogy of the grocery store checkout. You're standing in the line that isn't moving, that's big tech.
Yeah.
Meanwhile, the line next to you, industrials, financials, is flying by.
That is exactly the feeling. And it's psychological torture for a trader. If you stay over-allocated to tech while these boring sectors rally, your portfolio stays flat while the market goes up. That is the pain. Watching the indices hit new highs while your count goes nowhere because you're stuck in the 2024 playbook. This is the 2026 rotation.
That is a crucial distinction. It's not about the market crashing. It's about being on the wrong side of the rotation. Let's get specific with some trade levels for the stocks we mentioned. If someone's looking at Intel, INTC, what are the numbers to watch?
For Intel, the bull case requires a break above $51. That confirms the uptrend. If we get above 51, the chart just opens up. It's blue sky.
And the bear case, where do we cut bait?
43.40. That is the primary support. If Intel breaches 43.40, it kills the faith in the margin recovery story. You do not want to be long below that number.
What about Alignment Healthcare, ALHC? It's at a 52-week high, so entering here feels a bit risky.
It is extended. The bull case target is $25. That's the midterm ceiling. You need to see sustained volume above 23.50 to get there.
And if it rolls over?
Watch 2150. That's the 50-day moving average. For those who don't know, that's a key trend indicator. Institutions often defend that line. If it retraces to there, it cools that growth at any price momentum. That's where you stop out if you're a momentum trader.
And lastly, GE Aerospace.
Bull case is $215. Institutional buy stops are just clustered there.
Let's explain buy stops for a second.
A buy stop is an order placed above the current price. It basically says, if the price goes this high, buy it automatically. It's usually used by short sellers to limit their losses or by breakout traders to catch a run. So if the price hits $215, all those automated orders kick in at once and can really push it higher.
And the floor?
$190. $190. That is major structural support. If GE falls below 190, it implies the supply chain headwinds are much deeper than anyone thinks, and that would be a very bearish signal for the entire industrial sector.
So we have our movers, we have our levels, and we have the macro backdrop. What is the bottom line for the listener right now before the bell?
The bottom line is discipline. The market is no longer selling macro fear about Greenland. It is buying micro results on earnings. But the volatility from this data dropped GDP and PCE. It is going to be messy.
So the advice is don't play hero at 9:30 a.m.
Don't chase the open. Let the GDP and PCE volatility clear the deck. Give it 30 minutes. Wait until 10:15 a.m. to see the real direction.
And the final check.
Watch 68.20 on the S&P. If we hold that level, the path of least resistance is higher. If we fail, we are heading for a January washout.
Take it tight.
Strategy out.